We now have our penultimate session for this morning, and I am very privileged to welcome Brian Coffey into the studio for today. Brian, thanks so much for joining us.
Thank you very much for having us, Jacobus. It's a pleasure, as always.
Yeah, always love hearing your thoughts on global emerging markets, and I think no better time to crack on straight into it. So I know you want to speak a little bit in your opening slides to fund performance. GEM, or emerging markets for that matter, obviously did really well through 2025 relative to the MSCI index, but there was this interesting tension between emerging markets and what quality companies were doing, and the market's largely apathetic tone towards quality companies. So interested to hear your thoughts on that, and then where some of the contributions came from a sector and a geographic point of view.
Well, if we look at performance, it was a slightly better quarter. Fund was up 5.1%, ahead of the benchmark slightly. That took us to 29.4% for the year for 2025. So a strong absolute number, but trailing the benchmark over the 1 year period. What didn't work for us over that 2025 period, our security selection in mainland China was a drag on performance. We had a curious position of good exposure to quality names in China, which didn't work at the start of the year. And although it improved towards the end of the year, overall, that was negative for us. We had exposure in some of the smaller markets in the ASEAN region, in the Philippines, Indonesia, Thailand, and they were a drag on relative performance. And our securities in India, which have been a multi-year positive contributor to the fund, had a tough 2025. Exposure in the GCC, stock selection there also didn't work, nor in Poland. And we didn't own Greek banks. So we got good returns from our holdings in Greece. But that was outside of the banking sector, which had a very strong second half to the year. So although Greece was a positive contribution overall, it was due to our overweight, and security selection was a slight drag. And then we were underweight South Africa. And we all know South Africa had a very strong 2025, particularly the materials sector, but also consumer discretionary, with Naspers doing well. And that was a headwind for performance on the fund. But we got some of the things right, obviously. And what worked for us was security selection in Hong Kong, security selection in the IT heavy market of Taiwan. Also, we got good stock selection in Latin America, in both Brazil and in Mexico. The underweight in India was positive, although it was, as I said, negated by the security selection in that market. And what did work very well for us was both security selection and the overweight in South Korea. So again, an IT, but it wasn't just IT in Korea, interestingly. The overweight in Greece, I'd mentioned. So not only banks in Greece was a negative, but being overweight that market was positive, as was the exposure in Poland and in Hungary. Individual names, we had an exposure to Xiaomi. This is the mobile phone manufacturer generally, but consumer discretionary products in China that had expanded into automobiles very successfully. And that actually was dragged down by pressure on the consumer in China in 2025. We mentioned Indian security selection, Max Healthcare Institute, which remains in the portfolio and is a very favored name of ours. They had a difficult 2025 because the valuation was quite high in the security. So despite strong operating results, that company was a drag on performance. And then I mentioned Indonesia, and BCA is the largest bank in Indonesia. And that was hit by just negative sentiment towards the market, and particularly by foreigners. Offsetting that, SK Square in Korea worked well for the portfolio. This is a holding company which has a large stake in the SK Hynix, the high bandwidth memory player in the AI space. And that was a very strong performer and a positive contributor to relative performance. And again, in that AI theme, Asia Vital Components, it's a chip cooling technology company. And we've got these small areas of the AI market where we're seeing squeezes in terms of supply. So not enough supply and therefore higher pricing and better margins for these companies. And AVC was one of the beneficiaries of that. In Brazil, we had Sabesp, which is a water utility in Sao Paulo, the largest municipality in Brazil, and that company did particularly well. So those were the key highlights for 2025 for us. What I would say is that the portfolio is very, very active at the moment. There's a lot of tension and capital tension within the portfolio. So we've got a lot of companies and markets that we're excited about, but markets are moving so quickly that you quite often quickly need to rotate out of those.
Thanks, Brian. Yeah, I know when you recently caught up, you're quite excited and optimistic about the market. And going on to those next slides there, I mean, you can see from last year, Eastern Europe, and then towards the latter half of the year, you already mentioned Korea. So it almost showcases a little bit of the lack of any correlation there, which more than likely speaks to the chart on the right-hand side there around how style actually matters, whether it's the growth, momentum, stocks, or your value and quality.
Yeah, so growth had a better name, so a better year. So the black line is growth, and you can see that did well. That was mainly growth in the AI IT linked sector, and again that explains in the left-hand chart why Korea was so strong. So we started off, you can see Taiwan is the blue line. It beat emerging markets, but not very dramatically last year. So it was a strong year. Bear in mind, emerging markets up over 30%. So beating that is a good return for Taiwan. But Korea materially beat it because of these bottlenecks that have developed, particularly in memory. So it started off in high bandwidth memory, which is the memory that's exclusively required for AI installations. But now we're seeing improved pricing in the lower echelons of memory, so in the DRAM 4 markets, etc. And Korea is the key emerging market for the producers there. We've got both Samsung Electronics, which had a very strong second half of the year, and we've got over 6% exposure in that name, and then SK Hynix and SK Corp being the holding company for that. Those were all big contributors to performance in the fund.
Thanks, Brian. I just want to narrow the focus a little bit on the second biggest economy in the world, which is China. You can see there's been an interesting dislocation across your investment styles there. Pretty stark, actually, on that left-hand chart there. So very keen to hear your thoughts on where valuations currently are and what those future prospects look like for 2026.
Yeah, we're probably a bit less excited about China than we have been in the past. So we've moved to an underweight position in the market. When you combine the Hong Kong and China exposures, we're about 3% underweight. So reflecting kind of a moderate view of the outlook for China. And that's mainly on the domestic economy. So the consumer remains quite challenged in China. So we're finding it a little more challenging to pick up companies there. That's been reflected in some of the larger names in the portfolio. So Tencent, Alibaba, they've had various periods of outperformance when the AI theme has been running in China. But essentially, these companies are exposed to consumers, and the consumer is cutting back in China. Money numbers in China don't look very supportive of the consumer. So we've been focusing more towards companies that are less facing the consumer, more positioned towards either domestic infrastructure spending but also towards companies that have significant exposure to export markets. So that's been one of the strong positives for China. The domestic economy was slow and weak and disappointing for most companies, but the economy itself managed to hit, surprisingly, exactly its 5% growth target, and that was driven mainly by the export sector. And I think most countries in the world are seeing that with Chinese either clean energy or EV offerings coming pretty hot and fast to the market. But you can see in the right-hand chart that why haven't we got an even larger underweight in China? Well, it's priced at attractive levels. So, relative to its past and relative to the emerging market overall index, China is looking pretty attractive on valuations. And the money numbers, while they're not particularly positive at the moment, they are improving slightly, and we look forward to seeing that pick up as we move forward.
Yeah, thanks, Brian. I think we acknowledge the Communist Party there sees a challenge with the consumer and probably an entrenched conservative consumer in China. And in a few of our previous discussions, we also covered a little bit of the population dynamics there and the challenges they're facing in terms of age there. But moving on, I want to look at sort of emerging markets more broadly. You mentioned South Africa at the start of your presentation as being a bit of surprise, especially on the extractive industry side. But looking at these pockets of, let's call them peripheral economies, if you will, not to discount their value, of course, but any interesting geographies you're looking at there, any outliers? Are valuations quite stretched off the last year's run, and how do you see these going ahead?
Yeah, we find the valuations generally in EM quite attractive. So, we've mentioned South Africa. We were underweight South Africa. It hurt relative performance last year. But if you look at the chart in the left-hand side of the table there, you'll see mid-table, you see South Africa. It's not particularly expensive. So we've seen a very, very strong market, but earnings have been delivered by the companies, particularly by the extractive companies. We've seen a very significant increase in analyst estimates. And we're continuing to see strong precious metals and PGM pricing. So we're likely to see further catch up from those. So that looks attractive. Brazil looks incredibly attractive to us, but it has done for some time. The politics has become less appealing to us, as it looks as though Lula is better positioned to win the next presidential election. We were hoping he would be replaced by a more right-leaning politician. However, the valuations are particularly attractive. We know that international investors are underweight this market. In addition to that, they've got the highest real interest rates in the world. So interest rates are in the lower teen levels in terms of overnight interest rates in Brazil, but inflation has come right back down. So very high real interest rates. As a result of that, domestic investors are underweight equities and significantly overweight fixed income. Why wouldn't they be? A risk-free pickup of 7 to 8% is very attractive in most markets. But we think that this year we're going to see interest rates coming down across many of the emerging markets, and we expect that that'll be the case in Brazil, and that will push those domestic investors in addition to foreign investors into Brazilian equities. So despite the unhelpful headwind of a left-leaning politician, we think that the Brazilian market is looking particularly good. You see the most inexpensive market in that grouping that you see is at the right-hand side, and that's Egypt. And we've taken a small position in Egypt, or almost 1% exposure to it. It's not a particularly liquid market, so it's hard to find names that are easy to access for international investors. But we like a couple of companies there. We've got a property company, TMG Holdings, which is doing very well in Egypt, but also in the MENA region. They've got exposure to some of the larger economies, including Saudi Arabia, which we don't find particularly exciting at the moment, although we're finding in emerging markets that things are moving around very quickly. And we've also got the commercial international bank in Egypt as well, which is the largest domestic bank. And so, lots of things that we're excited about. We continue to be very positive on Korea and Taiwan on the back of AI. That is being priced very, very quickly into securities. And in fact, significant future earnings are being discounted by markets. So we're having to move and take profits in positions and find new names where the next bottleneck appears. But, there are lots of things that we're very excited about in emerging markets. So I would highlight Korea. We've mentioned the memory names and how those are delivering very high profits. And that looks likely to continue for probably 2 years, although the discounting that's going on in the market may mean that we reduce exposure during that period. But there's a very long, solid runway there. There's also a value up sort of program going on where companies are trying to do more for shareholders, so increasing payouts and buying back shares and cancelling those shares, which is very unusual. We've also got defense spending in Europe, and they're looking for suppliers outside of the US, surprisingly, or maybe not. But Korean companies are well positioned to benefit from those sorts of themes. And so we're overweight Korea at the moment, and we find that very exciting. And of course, you can't think of AI without including Taiwan, where TSMC is the largest play in the whole of EM in terms of AI. But there are lots of smaller companies feeding into that AI, if you like, environment, where we're finding bottlenecks are leading to very high pricing and very visible and sustainable order books for these companies. So things like AVC we've mentioned, Acton is a company that's involved in high-speed switching, and all these things look very, very exciting to us for the next year. We have reduced exposure to the ASEAN markets, so we were overweight last year. That didn't work. We can't see the catalysts at the moment, although interest rates are coming down, and that should be positive, but we've reduced exposure there. But what I would say is generally for emerging markets this year, we think it's going to be a very dynamic year for the portfolio. So we may end up exactly where we started in terms of country or sector exposures, but there will likely have been a lot of toing and froing in between as we just deal with how markets are valuing securities. But we are excited for emerging markets overall.
Okay, thanks, Brian. Yeah, I mean, your comments on Brazil are interesting around, the left-leaning government there, and you're looking for something a little bit more conservative. Maybe there's a hangover from the Bolsonaro years, but you're looking for something that is more prudent in terms of the national fiscus and the management on that side of things.
Yes, that would be helpful. But we think the biggest catalyst is going to be interest rates coming down. And we think that, there's obviously the debate about whether interest rates are too high in the US. They are clearly, I believe, too high in Brazil. And when they come down, that will push the domestic investment community to look more towards equity. So we find that very exciting. And the valuations are attractive. So although it's not good that we've got a left-leaning politician, it's in the price.
Okay, brilliant. I think, what came out through your answer and the subsequent answer was little pockets of opportunity around the world where you seek to find it. So my parting question to you is around your assumptions going forward. We've seen the facade of your colleagues walking behind you, hard at work, applying their minds, and I know you have your investment committee meetings. So what does your research and your assessment suggest for 2026?
So our economic work leads us to expect a modest slowdown in the first half of 2026. So, Simon, our economist, does a lot of work on business cycles, on global liquidity conditions. Global liquidity conditions are moderating. So that's a headwind for economic activity. We're not thinking slow down to the extent that you would start to see, worries about an economic relapse or anything, but we just think things are going to be more difficult in the first half of the year. The stock building cycle has just passed its peak, and so typically that's been a tailwind for the last 3 years. So you had low stock building levels globally, and has moved up, and we now seem to be past a peak. The caveat on that view is that the trade tensions that we're seeing is leading to more production facilities around the world in many industries, and that generally will lead to a higher overall inventory level. But we think for the first half of this year that we'll see inventories coming down. That will be a headwind for the global economy. Emerging markets, money growth for us is looking better than in developed markets. And overall, the combination of developed and emerging markets, the money picture is looking positive overall. And that's generally in an environment where historically emerging market has significantly outperformed developed markets. So that's where we're coming from. We think we've got this period where there's going to be some uncertainty introduced into global outlook. That can prompt cuts in interest rate, which we think are warranted in many jurisdictions, and that will be the driver for a much stronger finish to the year, we think. So lots of things that we're excited about, lots of activity going on, and very difficult to actually chart a path as to what we think will happen. We've seen the extreme moves in a lot of the material companies, particularly in precious metals. We've seen the instant discounting of future earnings in a lot of technology sectors. We're seeing the movements that we've seen across corporate responsibility in Korea and its exposure to AI and other trends. And so we think this is a good time for emerging markets. We think a weak dollar, which is what we're expecting, that the dollar will continue to be weak. It'll be volatile, but we think we're into a period of a lower dollar, and that's generally positive for emerging markets. So we think the stars are lining up very nicely for 2026.
Thanks, Brian. Maybe more observation is the old, I guess, order of trade seems to be shifting a little bit, and all the countries you've mentioned are diversifying their trading partners, probably leaning a little bit less into dollar reserves than they may have in the past. So definitely fascinating times, and we
Fascinating.
absolutely, as always, appreciate your comments and the team's work, and all the best for the year ahead, and we'll catch up with you next quarter.
Yeah, look forward to updating you then. Take care.
Wonderful. Cheers.